everyone in this room has probably lived with less money at some point in time than they live today, and were under the same stress on Friday or at the end of the month that they are today. It does not matter how much money you make unless you understand how it works and you take control of it. We have clients that make $20,000 a year and have more savings than clients that have $400,000 a year of income. It's possible. The ones with the higher ones, the money's been coming in for so long, they get used to it, and next thing you know, if it stops or hiccups, they're in just as bad a shape as somebody that's only making $50,000 or $100,000 a year. And the vast majority of them have very little money at the end of the month and are under a lot of stress and are in bondage, in financial slavery for 20, 30 plus years already today. They have no hope of getting off the financial hamster wheel. They have no hope of getting off the financial hamster wheel when they already are in debt for the next 30 years of their life and they're right up against the edge. They can't even slow down a little bit. Can't get sick. Can't have a layoff, can't have an economic downturn, or at all the house of cards collapses. Next thing I want to show you is how compound interest works. It's interesting, we had several people that had no idea, they'd never even heard of compound interest, but we want you to see what's going on here. Compound interest is powerful. It is said, and I can't prove this, that Einstein said that compound interest was the eighth wonder of the world. He said either you can earn it or you can pay it. It's your choice. It's either working for you or it's working against you. If you are aware of how it works and if you are aware of what's necessary for it to work, you'll be able to you'll be able to be in control of it because you understand what's going on. So we're going to do it. This is a very graphic example. This assumes 100% compounding, which could happen, but is not likely to happen for most of us, but it's dramatic, and I want you to see it because it expands it for you to really catch the idea. We start with a penny on the first day, and because we're compounding, we get 2 on the second day. The compounding then means that on the third day we have 4, and the fourth day we have 8, and the fifth day we have 16. You see the compounding? By the 22nd day, we have $20,971. And right here, and life happens. Life happens that day, and we have a medical bill, we need a new car, we put a down payment on a house, we got to send one of the kids off to college, and that money, the compounding immediately stops because we had to use that money. In life, it could also have been my money's in the markets, or it's in a fund of some sort, and I had a loss in the fund, or I had a stall in the fund, or I had a reversal in the fund, like 2007, 8, 9, and 10, when people's stuff was just climbing like crazy, and all of a sudden they had a 40 to 60% pullback. That's an interruption in the compounding. See, in order for compounding to work for us, compounding has to be uninterrupted and continuous. Uninterrupted and continuous. Up to this point, it's been uninterrupted and continuous, and a penny is now $20,971. It's interrupted, we have to start over. 1 penny to 2, and at the end of 31 days, we have $2.56. Anybody want to guess how much that would have been on day 31 if the compounding had never been interrupted and had remained continuous?
Several million. I can't remember the exact amount.
Several million, Hazel. Yep. $10,737,000. So yeah, $10 million because the compounding is uninterrupted. Or we're back to a penny, or $2.51, whatever it was. You get the idea that in order for compounding interest to make you money or to make you wealthy, it has to be uninterrupted and continuous. The size of the compounding is not as relevant, although the bigger the better. But the fact that it's continuous and uninterrupted, and the reason that everyone in this room is not wealthy beyond measure because of their compounding interest is because it's always being interrupted by the markets or by life, one of the two. Next concept you need to understand is how banks work, how they use money. because they use money differently than you do, because they work on a totally different playing field, with a different set of rules as well. I'm going to get myself a pen here. So in order to give you a graphic picture of this, I'm going to tell you a true story. Our daughter-in-law, works for Wells Fargo. She started there after college, age 22 roughly, and she went to work for Wells Fargo, and when she started working there, they said to her, hey, you're an employee here, we want you to have a checking and savings account here. So every Friday, Wells Fargo would pay her, and the money would leave Wells Fargo and go into her Wells Fargo checking account. After a little while, she needed a car, get a new car, and they said, no problem, we'll finance the car for you. So Wells Fargo says, every month, at the end of the month, money leaves Wells Fargo and goes back to Wells Fargo from one account to the other. That's all that's happened for the car payments. A little time goes on and she meets our son. They get married and they decide they need a house. So they go to buy a house, Wells Fargo's there. We're going to make sure you get a mortgage for that home so you can start your family and get things going. So once a month, money leaves Wells Fargo. Where does it go, people? Wells Fargo for the house. A little more time goes by, and they're going to have a baby. So they decide it's time to finish the basement of the house off. And Wells Fargo says, no problem, we'll give you a HELOC, a home equity line of credit. So once a month, one more thing leaves Wells Fargo and goes to Wells Fargo. Now along the way, of course, she needed a credit card and a debit card and all of that. So once a month, that gets taken care of. The credit card, once a month, leaves Wells Fargo, her account, and goes to Wells Fargo's credit card account. You seen a pattern here, anybody? One more insidious one, and this truly is the most insidious one, is they said to her, she's 22 years old now, they said to her, you know what, you're a valued employee, so what we're going to do is we're going to set up a 401k for you, and every week we're going to take some money out of your paycheck, and we're going to put it in the 401k for you, so that later on in life you're going to have all kinds of money. So every week they take money out of Wells Fargo and they put it into her 401k. Now, we're going to take that out of your paycheck every Friday, and we're going to put it in there, and guess what? In 40 years, we're going to let you use it. In 40 years, we're going to let you use it. Who's getting to use it for the 40 years? Wells Fargo is. That's exactly right. See, if you haven't seen a pattern here, in this whole picture, do you want to be our daughter-in-law, or do you want to be the bank? You want to be the bank. And then, at this point, somebody usually is thinking to themselves, well, Tim, not everybody works for a bank. Well, let me tell you the truth. The truth is it would be better for Wells Fargo if all of that initial money came from somewhere else, from somebody else's bank. And then, because once you start with one bank, most of you will end up doing your mortgage and your car and your credit cards and your checking all at the same bank. Maybe a couple different ones, but by and large, most people are pretty loyal about that and they want it easy. So now the money's coming from somebody else's bank into Wells Fargo, and now it's circulating in there. That's actually better for them. But as we've already determined, there is still one place that would be better overall, and that's that if that was your bank. Because if that was my bank, would I care about making my credit card payment every month if I was just going back into my pocket? No, I wouldn't care at all. And is it just going back into my pocket, or does something else get added to it when it comes back? Yeah, interest. So when the bank loans me money, they don't just get their money back. They get their money back plus some interest on top of it. That's what they're in business for. In your books, you're going to find a little digital representation to this to remind you. But the next thing I want you to understand is the interest rates going on inside of a bank. So if Chloe, if the bank gives you 1% interest on your savings deposit, I know it's a math test, I know, yeah. 1% interest on your deposit into the savings account, but then they take your money and they loan it to me at 4%. How many percent profit is that for the bank? They're giving you 1, and I'm paying 4. It's actually 3 points of difference. So you're saying it's either 3, 4, or 5%, somewhere in that range. Yeah, that's the most common answer. 3%, the difference between the 1 and 4 is the most common answer. But that's just percentages. That doesn't take into account at all the fact that that's actually a 300% profit to them. It's 3 points of separation, but it's 100% profit, or 300% profit, my apologies. So put this into perspective. It's the difference between 1 and 3 is 300%. But the banks are allowed to do this multiple times with money. See, if Chloe gives the bank $100, they owe Chloe $100 because she's parking it there. They now have a liability on their books. They owe Chloe $100 because that's her money. But the bank is allowed to keep 10 of that dollars, only 10, and in some cases 0. But let's just stick with the 10, and then they're allowed to loan out $90. So they're allowed to loan out 9 times more than they have just on that one transaction than they actually have. But remember, they still owe Chloe $100. So they've just created money completely out of thin air. That money does not exist. To prove that, go to your bank on Monday and say, I would like to withdraw $10,000. Now, it's a good idea to make sure you have $10,000 in there first. Otherwise, they get upset. Okay. So go in there and ask them for that, and they will tell you to make an appointment and come back later. They won't have your $10,000, and they won't most likely give it to you. Now, some of you have relationships with their bank. That may happen. Sometimes I can do it, sometimes I can't. But by and large, they don't have a whole bunch of money sitting around. It's not like you see in the movies where the vault's just full of cash. You know, it just doesn't work. There's not pallets of it in there, you know. Some banks are moving so much that there's money in there, and there's a lot of it. But if you go to our small bank, there's not going to be much cash. I have been told to leave and come back in 24 to 48 hours because they would actually have to bring the money in to be able to pay me the $10,000. That is mine. But they don't have it anymore because they've loaned it out and or ran it through the system. Banks never let money sit. Keep that in mind. The average U.S. bank is actually, by the time they do this, remember we said in Chloe's case it was 300% profit on one of those transactions. But what if they were doing 9 or 10 transactions with that same dollar? That would be maybe a 3,000% profit just on a 1 to 4 ratio. Well, with a credit card, it could be 1 to 29% ratio. It could be 1 to 14%. On a house, it could be 1 to 6, or a business loan, 1 to 6 to 8. You get the idea that these percentages are big. The gross potential profits on these could be as high as 3,500 to 7,000%, depending on the types of loans. Less all the expenses and stuff, they're making a lot of money. This is why you find really nice banks on every corner of every town, everywhere. And not just one. I mean, look at Denver. But we travel a lot around the country. We were just recently out in the middle of nowhere in Kansas, little tiny farm and ranch town, and there were like 4 banks in the center of that town. You know, I can't imagine anybody ever even goes in there. There's just not that many people. But there's that much money involved in the banking industry. All right, so the next thing we're going to look at is, we talked about compounding interest, and if you remember, we said that in order for compounding interest to work for us, it needs to be uninterrupted and continuous. And as powerful as it is even then when it's uninterrupted and continuous, and remember, we're not going to throw this out. We want to use compounding, but we want to use it the only way that it works. But there is something more powerful than compounding. It's actually known as the velocity of money. Some have called it the motion or the movement of money. And in nature, everything is moving constantly. You may look at a rock and think it's a rock, but the reality is the molecules, the atoms, the neutrons, protons, all of this stuff is vibrating constantly. It never ceases moving. It's always in movement. Water is of no value to you unless it's moving. Your blood won't do you much good if it's not pumping through your veins. Everything in life needs to be moving continuously. And you know, our winds are moving, the waters in the world are moving, the earth is constantly revolving. Movement is a part of nature. It's a part of the laws that are at work. We want to do the same thing with our money. So I want to show you the difference in the power in the velocity or the motion of money. So I'm going to give you a graphic picture again, and it's in your booklet. But we're going to say that This hardware store owner hears about compounding interest in this 8th wonder of the world, and he decides he's going to take a can of paint and he's just going to let it sit on the shelf and increase the price of it every year by 10% for 11 years. So he's going to compound the price of the can of paint so that it will be worth more in 11 years than it was on the first day. It was worth $6 on the first day. Compounding over 11 years, it's worth $18. That means he's made $12 just simply by letting the paint sit and get compounding interest. Okay? But I just said that there was something more powerful than compounding, known as the velocity or the motion of money. So let's look at that. Now, if the owner had decided to take the can of paint, take the profit, and turn it 10 times. So he'd take the can, he'd sell it for $8, pays $6, sells it for $8, makes $2, and as soon as he gets his money, he goes back with the $6 and buys another can of paint. He does this 10 times a year, and in so doing, he actually makes $20 in that year by moving the money and keeping it in motion, keeping it flowing instead of just sitting. Well, let's compare that to our others. Over 11 years, that means he generates $220, or he actually creates a difference of $208. So the motion of money was almost 20 times more powerful in creating money than compounding interest. We already know compounding interest is powerful, but this concept, this financial truth, is even more powerful than the compounding is. Another place you hear about compound or the motion of money instead of the compounding actually, but this was a commonly understood principle all the way back even in biblical times. Remember I told you the Jewish traditions regarding money are very solid, and they've been around for thousands of years. So solid that if you will remember a story in the Bible called the parable of the talents. And the parable goes like this. Some followers come to Jesus and they say, Jesus, when are you coming back? And he says, I don't know. No man knows, and the Son of Man doesn't know. I don't know when I'm coming back, but let me tell you a story, a parable. And he says there was an owner, a landowner, who left for a long journey, and before leaving, he gave 1 talent to one servant, 3 talents to another servant, and 5 to the last servant. And upon his return, he expected to get his gains from that. He went to the first servant, and the first servant returned to him the 1 talent he'd been given. And the master said, what's the deal, you know? And he said, well, I knew you were a hard master. You reap where you do not sow, so I just buried it in a hole in the ground so I could return your capital to you. And the master says to him, you wicked and slothful servant, the least you could have done with my money is give it to a banker and gotten me interest. Okay, this is Jesus of Nazareth using an example that today's society doesn't much understand anymore. But to the Jewish people of that time, they fully understood about interest and about letting money sit and about the motion of money. And it's important to understand what those words meant as well. Slothful is pretty easy to get. Lazy. You didn't take any risk. You didn't put any work in. You just dug a hole, buried it. That's easy to get. But the word wicked, unfortunately, gets lost. Many times it's translated sin. And we think of that as some sort of moral issue. The literal translation at that time was wickedness, meaning you breaker of the rules. What rules did he break? Were they moral, religious rules? No. He broke the rules of how money works. You could have at least given it to a banker and gotten me interest. So the point was, to the Jewish people, they understood that principle so solidly. See, when you're making a spiritual truth known and you use an example, the example you use, the financial example you're using, has to be true in order for the spiritual truth to be true. The financial truth has to be true in order for the spiritual truth to be true. You can't teach a spiritual truth from an untrue financial truth. And it also has to be something that they commonly know. So the Jewish people at that time understood these principles. It's lost on our society today. The second servant had 3 and he returned him 3, and the last one had 5 and returned him 5. They had put the money to work, and repeatedly made more money with it until they'd each doubled the money. The next part of the story goes this way. When seeing this, the master took the money from the servant that only had one and gave it to the one who had 5. Now, I've heard this from pulpits, and I've heard this in other places told, that the first guy was being punished for his laziness and his wickedness. That's not at all what was happening. And essentially, he certainly did lose some favor. That wasn't the case, though. What was happening is the master was a wise man. He took the money from the guy who got him 0 returns and gave it to the guy who gave him the maximum returns. It's good business. It's just wisdom when it comes to money is what was happening there. We hear these stories so often and just don't get the true meaning. So even we have documents written thousands of years ago that are teaching the same thing that we're trying to bring back to you today about the motion of money. Another thing we want you to understand is when you're looking at the returns that you might be getting is what is an average rate of return. This one's going to surprise you a little bit. First of all, I want you to know that everything I'm going to show you is also legal for them to do. It's not illegal to give information in this way. It's being slowly corrected. Some of it has been, but this is still reality. Remember I said earlier that a lot of times you view money through a certain set of glasses, and you think you understand what's going on. So if I were to give $1,000 into, let's say, an investment, and I got a 20% return in my first year and a 20% in my second year, that's an average 20%. And I would now have $1,440. See, when I talk to you about an average 20% rate of return, this is what the picture you have in your head, is I'm going to end up with $440 more on than I had before. But the reality is that it's totally acceptable and mathematically totally accurate to take that same $1,000, get 60% up to this point or that year, lose 20% the next year, still honestly state that that's a 20% rate of return, but only have $1,280. They're both an average rate of return of 20%, but I only have $1,280 instead of $1,440. Well, that's not so bad, and most people aren't going to complain a whole lot or even ask too many questions because they were expecting $440 extra dollars, and they only have $280 extra dollars, but at least they have extra dollars so they don't say much. But it is also just as accurate to have doubled my money along the way, lose 60%, that's still an average rate of return of 20%. I now only have $800. I've lost $200 of my original money, and it's still totally acceptable for them to tell me that I've had a 20% average rate of return. And if you want to get all the in-depth details of this, and somebody else pulling the curtain back on this in the industry, is Tony Robbins. And I don't read a lot of Tony's books, but he wrote one recently called Money, Master the Game, which actually is a financial treatise. It's very well written from a financial perspective. And he actually pulls the curtain back in the very early chapters of the book on just this kind of things going on. While the rates of return you're being told you're getting aren't really what you're probably being told you're getting. So now it gets even worse. Let's say I'd made 140% up until this point, and all of a sudden the stock, the 401k, the company I'm in, or whatever, the fund fails, the market completely tanks. They're still allowed to tell me I have a 200% rate of return, and I have lost 100% of my money and I have 0 left. See, when you're getting a statement from your financial planners or from your funds, you need to do the math to find out what kind of return you're getting. You can't just take the numbers on there because they're allowed to do some things with those numbers that you would never expect. You expect those numbers to mean I'm making money. If I have a rate of return, how in the world can I have nothing left? But I'm telling you, it's totally acceptable in legal form to do that. It goes further. Not only are they allowed to tell me I had a 20% rate of return, but they're allowed then to deduct the expenses related to them managing my fund for me after they tell me that rate of return. So again, I still don't necessarily have an accurate amount of my return. According to the research I did recently, the average fees that are being paid by people with any kind of money in any fund at all is between 3.1 and 3.53%. So of every dollar you put into the fund, you are actually, somebody else is skimming off the top for their services, let's say 3.5%, okay? About the lowest you're going to find is about 1.5%. And we had one person in class a few months ago that after being in class went to find out what they were really paying. The first thing they did is they went to their manager and said, I want to know what my fees are costing and I want to know how much the percentages are. And they said, well, we don't give out that information. And he said, aha, I was just in this meeting with Tim and Marcy. And they said that you have to tell me by law. Remember, I told you there are some changes coming. It took him a month before they turned over the information. 7.5% he was paying on his fund. Now understand, again, you're thinking 7.5%, much like Chloe was thinking 3% was the difference between 1 and 4. Her math is correct, but in the real world, it's not 1.5 or 3.5%, because remember this is that compounding working against you. If you give this man $100,000, or this lady that's going to manage your fund for you $100,000, they get to take, on average, 3.5% out of that fund every year, whether it made money or not. So in the first year, you have $100,000 and they get to take $3,500 of it. Let's say they made you 10% that year, and the next year you have $110,000. They now get to take 3.5% of $110,000. But let's imagine that they made you no money that second year at all, and you still only have $100,000. They get to take another $3,500. Totally acceptable. It's what you signed on the dotted line to do. You just didn't understand that's the way it worked. So when you take your money and park it in some of these 401ks for 40 years, what you're signing up for is the hope and the dream and the desire to have more money at the end. That's the promise. But the reality is the only thing you're guaranteed in any of that is that somebody else is going to be taking off 1.5 to 3.5%. That's the only guarantee you get, is that they're going to get paid whether you make money or not. I'm not here to bash an industry. There are some very good people out there, but it's 1 in 100. A lot of it is product-based. A lot of it is just selling products. A lot of you think that when you put your money with a financial planner or an asset manager of some sort, you think that he wakes up every morning and checks your accounts and moves money around and does stuff with them to make sure that you're maximizing it. That guy is about 1 in 1,000. The vast majority of them say, oh, Hazel, you got $100,000 for me to invest? No problem. I'm going to put you in this fund and that fund and that fund. And that's the last time they look at it, unless somebody else higher up says we need to talk about moving some things around in other funds. Again, I'm not here to bash it. You just need to know how it works and find out, is it working for you or not? And you can't take the numbers at face value. If you want to know what's really happening, take the balance at one point in time and the balance, the actual cash value that you could remove from it, the actual money you could take out of it at 2 different points in time, calculate the difference and figure the percentage that way. It's the only way you're really going to know. You will not be able to know from the documents that you're provided. Marcy and I ran into this. Remember I told you we started on a whole new journey about 10 years ago? After having money with some very reputable, solid, likable, honest, very character-driven individuals, they kept telling us what our average rates of return were. 6, 8% year after year after year. Unfortunately, when we finally took ownership of our money, stopped trusting what other people said about our money and looked at the numbers, there wasn't any more money there. There wasn't any significant amount of money to justify having parked that money for 10 years there. And when we did the math, we found out that our net growth hadn't even been 3.5% over the whole 10 years, even though we'd been being told we were making 6 to 8% year on year. See, they get paid even when you lose 100%. Now, once it's down to 0, then they don't get paid anymore. And they'll tell you when you ask them, it's like, well, what's your incentive? Well, the more money you have, the more percentage I get. That's my incentive. But they're not incentivized in the same way you are, because if you lose, yeah, they're out 3.5% of that next year, but you're out 100% of it forever. Yeah, just to understand that's the way that it works. when you do make money, you've got certain things you have to do with it. Remember I said we need to figure out a way to use money more than once. When we make money, we have our living and our lifestyle expenses immediately to deal with. Now, let me differentiate these two for you. Living is food, clothing, shelter, and transportation, okay? Lifestyle is how expensive those are. Because your transportation can be a $5,000 used car, or it can be a $50,000 car, or a $100,000 car. It's transportation either way. The lifestyle is the issue. Your shoes, your clothes, the food you eat, the place you live in, all can vary in the cost of it to you. So right now in America, most people's money is gone right here. Remember what we said before is that Parkinson's law states that expenses will grow to meet or exceed income. See, I've had people tell me, well, yeah, Tim, I know about that. The problem in America is everybody spends everything they make. That is not any longer the problem in America. The problem now is that we spend everything we make and everything we can borrow. This is where the slavery and the bondage ultimately comes in. This is the reason you can't just stop and climb off the hamster wheel. Okay? Understand that, well, we'll get to debt reduction in a minute, but understand that it's not about just spending all you make, it's about borrowing more than you actually have. Give you a picture of that. In America right now, and the number is growing, so my number is probably outdated. The newest form of debt in America is cell phones. $60 billion last year of financed cell phones. That was last year. I have no idea what it is currently. $60 billion just on cell phones has been financed. And dramatically, the vast majority of the people that are doing that are people that can't afford the $1,000 cell phone. So they're financing it. $35 a month, $25 a month, whatever it is, but it's $60 billion worth. We understand that we got to have some savings or emergency fund. We're already done by the time we get done with living and lifestyle. Most people don't have anything left, but now we understand we got to have savings and emergency funds. So any plan that I help you provide or develop for yourself has to include a decent living and lifestyle. It also has to include having some savings or an emergency fund. The harsh reality is that according to GoBankingRates.com, in 2016, if you look at these numbers here, let's see if I can get this bigger for you. Right here, 34% of Americans at the end of 2016 had $0 of savings. 34%, and the next 35% had less than $1,000. So that's 69% of the American population at the end of 2016 had less than $1,000 of savings or an emergency. If they had an emergency that was over $1,000, they'd have no way of meeting it at all, other than more debt. Yeah. So we need to keep that in mind. Debt reduction. You're told all the time, you need to start reducing your debt. Get out of debt, get out of debt. And I agree, couldn't agree more. The fastest, easiest, well, maybe not easiest, because it's going to take some changing some habits, but the fastest and most assured way of increasing one's net worth or overall wealth is to reduce debt. It works 100% of the time, and there's no downside to it. You can't get hurt by reducing debt. See, net worth, for those of you that don't know how to calculate that, it's all of your assets or asset values, which would be cash, cars, houses, properties, whatever it might be, bonds, stocks, whatever, less any debt that you have is your net worth. So if we have zero debt, our net worth just went up dramatically because now it's just equal to all of our assets. Fastest way to do it is by debt reduction. Retirement and long-term care, we have to start thinking about that. There's a great little book. If you don't have it, you can go to our website. You can actually download the PDF for free or order a copy if you like a hard copy in your hands. But it's called The Richest Man in Babylon. Especially for you young folks in the room, it is a great little allegory that has all of the basic truths about money in it. It does. It's in a simple little story. Rule number 1 is pay yourself first. Okay? Pay yourself first, meaning before you go spending money or before you decide how much money you actually have to spend, you need to be setting some money aside for your own future, for your own well-being, and for your own ability to grow wealth. Pay yourself first. Asset protection. Somewhere along the line, if you do start to accumulate some money, somebody's going to say to you, we need to start creating some sort of schemes or whatever to protect your money. Usually what that means is paying a lawyer or an accountant or somebody else a lot of money to help you protect that money and then paying them money to maintain it for years. But if you do start to accumulate wealth, you do have to protect it. Investments or wealth creation. Some way, the only way for you to ever get beyond where you're at or get beyond the money flowing in every Friday in your paycheck is to have some other source of passive or residual income coming in that is some sort of investment or wealth creation vehicle. But all of that takes money. See, we only have $1, and right now we're at 6 places you need to be using it. And then generational wealth. In America, this has pretty much been forgotten about because most people are already struggling here and here if they're lucky, and some got to debt reduction, and that's the end of it. To think about leaving anything for the next generation is not likely. We have clients in their 70s that are looking for jobs because the money has run out, and it's just they need to pay the bills. Social Security does not cut it. It was never intended to be everything to you or for you. It was never intended to be everything for you. That's something most people didn't know. They think they got a built-in retirement plan. You do not. It is not enough. And there's a whole bunch of things that go along with that I don't have time for today. Tommy, normally I would break here, but if everybody's okay, I think we'll just keep going. Okay. So ignore the break timer, guys. So we're going to head now is when we're working with money, most people work on one of 2 systems related to money. The first one I call the borrower. The borrower takes money and give you a little nomenclature here. Even, this top line is even. That's either $0 or $100,000. Doesn't matter. It's even. It's just the flat line. It's where we start with. Then we borrow money. And over a period of time, we make payments back until we get back to even. Then we borrow money again, and sometimes we're borrowing these overlapped and at the same time. But you get the point. Either way, we make payments over time, and we return back to even each time. Well, somewhere along the line, somebody told you, never be a debtor, be a saver. And it is better. It is totally better not to have that guillotine of that debt hanging over your head. There's no question about it, but I want you to see the basic premises here. I started even, and I save money for a while, and then I buy the car, and I'm back to even. I save money for a while, and I pay the medical bill, and I'm back to even. Either way, I'm making payments over time, and I always return back to even. These are the 2 systems that have been offered you. Remember I said that the system loves to offer you saying, here's your choices, pick one. But what if there's another one that nobody wants to talk about? And there is another one. It's what we call the private banker. The private banker. It's what we call the private banker. Yeah. It's what we call the private banker. See, in the private banker scenario, you're going to notice some patterns that are very similar to the first 2. One is the saving. We're going to capitalize our own bank for a period of time, and over a period of time, we're going to be saving. We started even, and we're going to save some money. And just like with the borrower image, we're going to borrow some money, but this time, we're going to borrow it from ourselves, from our own capitalized bank. We've put money away for ourselves, and we're going to borrow it from ourselves. Okay, just like we did in the other scenarios, but as we make the payments back, with interest, just like we would do with anybody else. And in this whole concept, I'm going to ask you to treat yourself at least as good as you would treat Visa, MasterCard, Discover, Ford Motor Credit, GM Motor, whatever. I want you to treat yourself at least as good as them. I want you to make payments regularly just like you would to them, and I want you to include interest. And by doing so, I will never return back to even. Even is here, and I've climbed up to this point. I borrow money and I pay it back with interest to myself, and over a period of time, this becomes my new wealth line. This becomes my new net worth. I never go back to even in this scenario. All I've done is capitalize my own bank. What did you decide earlier when I sketched it out for you in our daughter-in-law's example? Who did you want to be in the picture? The bank. That's right. That's exactly what we're doing here. But I want to show you some other features to this along the way, and this is where we start to get into the private banking concept itself. Private banking concept isn't a product. It is all of these truths brought together in one truth or one concept or one way of approaching and using money so that you are on the positive wealth creation side instead of on the hamster wheel side. That's all it is. It's a bunch of truths. See, right now, we already talked about this a little bit. You make money, you spend that money, and somebody else ends up with it. That's the way it works. And that's when I say to you that there's another way, most of you would say that can't be true, Tim. But let me show you again. I'm going to keep going back to this. We've already decided we want to be the bank. So if I'm a bank and I give money to somebody for financing, I get back over a period of time, I get all the principal and interest back. Is the bank ever out anything? Permanently out anything? No, they're not. They're never out anything. Matter of fact, for every dollar that goes out, they get $1 plus back. I don't care if it's only 4% interest. For every dollar that goes out, they get $1.04 back. But the reality is they don't just get $1.04 back. Because remember, we said that this interest continues on for a period of time. I don't care if it's just a car at 5% interest. You're going to pay them 5% on the first year's principal balance, 5% on year 2, 5% on year 3, 5% on year 4, and 5% on whatever. Year 5, we just saw somebody the other day financed a car for 6 years because it was so expensive. They couldn't afford it otherwise. That wasn't their first clue. They just extended the payments. Because we've been trained to say, can I afford that monthly? The real question is can I afford that? So they intentionally ask you, can you afford that monthly? Because they know you can't afford it. So again, in this scenario, who do you want to be? I want to be the bank. And in order for us to be the bank, we need one financial instrument or one financial tool to use. And we need some place to put that money that's going to start to meet some of these requirements that we have. And we've already laid them out, those 7 things that we talked about that you need to do with each dollar. The instrument that we're going to talk to you about is an instrument you've heard of, but you've never heard of. It's a whole life insurance policy. And you're going, well, that's just an expense that I don't want to have. And I get that. But that's the whole life policies that have been typically sold, and especially in recent years. There was also a big push for a long time that said, buy term and invest the rest. So just buy a term policy and invest the rest of the money. And we'll get into why that's maybe not the wisest thing to do. It might be great for the industry, but it might not be great for you. So whole life insurance is not, it's like cars. See, you can get a car and it can be a Pinto and it will get you from A to B. Or you can get a Maserati and it'll get you from A to B in a whole lot more luxury with a lot more features and a lot faster. Okay? They sound the same. They're a car, but they're not the same at all. And whole life insurance policies are the same. Now, this was actually new to us even. Now, Marcy had been in the industry for over 20 years in the financial industry, specifically in the whole life arena, in the life insurance arena. Started early on with one of the biggest companies in the country. And she kept saying there's got to be something else going on. Got to be. Because they kept telling her that incredibly wealthy people were using these instruments. But they wouldn't tell her why, because I don't think they fully knew why. But they just knew they were selling a lot of them to them. And she kept saying, I don't think we're doing the right thing by our clients by and large. There's got to be something more. And when we learned this, she literally went from a place at first when the man started to teach us, she got angry. And she said, quite frankly, this is BS. I've been doing this for 20 years. I've never heard any of this. 10 minutes more, she's in tears, going, I knew it. I knew it. I knew they weren't telling us all of it. I'd been asking and asking, and they wouldn't tell me. So what we found out is that not all whole life insurance policies are the same, and that they can be structured in such a way to accomplish what we want. Now, everything I'm here teaching you today about the private banking concept works without this instrument. This instrument just becomes a good place to park the money so that we get even more power out of it. Understand, it's just a tool. If we find a tool that's better than this, then we'll use it. But to date, we have not found one. To date, the man who originated these ideas to the masses, a man named Nelson Nash, he started in 1980 teaching and sharing these principles about how to use these policies if they were structured properly to change people's wealth. And he hasn't found a better instrument to date. And I think you're going to understand why as we go through this. So the only whole life insurance policy that we'll use has to be one that has high cash value. High cash value. Most whole life insurance policies, and I mean most, like 98% of them, will not generate as much cash in the first 5 to 8 years as we get out of our policies in the first 30 days. That's a pretty significant difference. We get roughly 50 to 58% cash out of them in the first 30 days. Most people are waiting 5 to 8 years to get that much cash out of a whole life policy, that much growth to be able to utilize. That becomes important later on. Keep it in mind. Guaranteed returns. Remember I said in most of these funds and stuff that are available, the markets, whatever it is, any type of wealth creation, there are no guarantees in any of them. We will not use an instrument, a whole life policy, that doesn't have a guaranteed rate of return. That rate of return typically is right around 4% guaranteed. Okay? That rate of return is also continuous, uninterrupted, compounded. Very important. We will not use a program or a policy that does not pay dividends. That means just like if you had a blue chip stock, that stock will send out dividend checks on a regular basis. We're allowed not only to get the guaranteed portion, but also to get dividends on top of it, and those dividends are also compounded into the program. So we're getting guaranteed between 4 and 6% uninterrupted compounding for life. As long as you're alive, it continues to grow at those rates. It's permanent. This is really important. This is another story that people don't understand. They mostly think that people buy life insurance, die, and somebody gets paid. Doesn't work that way. Here's how it really works. We're meeting with the vice president of one of the largest insurance companies in the country, having dinner with him. And I said, we were just sharing the other day about, with our class about how 96, 97% of the term insurance policies that are out there will never pay out. And he said, oh, Tim, your number's wrong. And I'm thinking I overstated it, but I had done some research and I thought I was accurate. And he says, no, he says the current numbers right now are term life insurance policies will not pay out 99% of the time. So 99 out of 100 term life insurance policies will never get paid out. Now, is that really in the benefit of you or the insurance company? Yeah, the insurance company makes out on that deal. The typical whole life insurance policy, 70% of those will never pay out. Because the way that they're structured is eventually you will be priced out of them. See, with a term policy, it literally means they're fixing the price for a term. Well, if I buy a policy when I'm 50 and I turn 70 and my term was a 20-year term, they're allowed to raise the price. How much do you think they might raise the price when I'm 70 years old? She says double. Anybody else want to take a guess? Try 10 to 1,500%. 10 to 1,500%. You're 70 years old. They know you're closer than you ever have been and ever will be at that point to leaving this world. They increase the price dramatically. One of the students actually went to the carrier and said, I want to know how much mine's going to go up to. See, people don't even know to ask this question. They buy the life insurance policy, and let's say it's $1,000 a year. And they say, well, I can handle that. It's kind of expensive, but I can handle it. They don't realize when they're 70 and they're closest to ever needing it before, that policy could go up to $10,000 to $15,000. Do you think they're going to be in a position at 70 years old to just tack on an extra 15 grand a year for maybe 10 or 20 more years? No. It's depleting wealth, not creating it. So the policies have to be permanent in nature. So we don't want something you can get priced out of. They have to be protected. See, in the state of Colorado, if you put money into some of these policies, after I think it's about 4 years, nobody can attach it. It can't be touched. It can't be touched in a bankruptcy or a lawsuit. And in other states like Florida, once it's in there, it doesn't matter if it's 1 day or 1 year or whatever, it's protected. That's why when O.J. Simpson got out of prison, anybody remember that story? Before when he lost a civil lawsuit demanding that he pay like $33 million in damages to Nicole Brown Simpson's family. But before he got sentenced and went to prison, and before he could have this brought against him, he took his money and put it into a whole life insurance policy in the state of Florida. So when he lost that, he didn't pay it, and they couldn't attach that money that was put in there. So when he got out of prison, he is living the life of a millionaire, even though he has now that $33 million due to penalties and interest has grown to over $70 million now, Marcy told me the other day. $70 million he now owns. He's living a life of a multimillionaire because he put his money into a life insurance policy to protect it. So the civil lawsuit, government, bankruptcies, they can't attach it. And in Florida, it only took a day before it was protected. He was a smart guy. He needed to protect it. He did before he lost, and he had it covered. The other thing he had was a contract with the NFL, which was a 401k, and a 401k is a contractual relationship too. And so that money was protected. So he comes out having a multimillionaire's income stream from 2 devices, even though he owes $70 million. This is another way that the wealthy play in a different playing field and by a different set of rules. You just got to know what the rules are. Because if you don't know, you can't play by them. The growth needs to be tax-free or we won't utilize it. So understand what I mean by that. Remember I said it's growing 4 to 6% compounding endlessly until death. Okay? But all of that growth is tax-free. They don't send a 1099 INT at the end of the year to you to file on your tax returns or a 1098. They don't send you any documents to say what the growth is, because that growth is actually protected by the way that it's structured. There is no taxable event in that growth. And it gets even better is when you pass away from this world, all the money in it transfers to your family or your beneficiary tax-free at a multiple level of what you've put into it. And you're going to see that as we go along. We will only work with a company that's A+ rated, AA rated, AAA rated, and it has to be a mutual company. This is important. Mutual literally means that the company is owned mutually by all of the policyholders, which means when they pay dividends or they have profits, those profits go to the policyholders, not to a stockholder. See, a stock company has to pay it out to their shareholders and on their stock. But if you're in a mutual company, all that money comes back to you. So they're working for you and with you, and the dividends come to you. Some little known aspects of a life insurance policy that are going to be important for you to understand is there's 3 parts to the policy. There's the owner, the insured, and the beneficiary. Now, this is important, and most people, again, make assumptions based on their own understanding. Man buys a policy, he owns it, and he's the insured and his wife's the beneficiary. That's the basic premise. Or the wife has a policy, it's on her and her husband's the beneficiary, or the kids are the beneficiary. That's the most common one. But these policies are contracts. Remember we talked about the power of contract? And in them we're allowed to do several things with these contracts. One of them is the owner can change. Or it can change, one. It can have contingent owners on it, which means I can actually transfer it to somebody else. Just simply I could pass away and immediately transfer a policy to somebody else, just that simple. Much like a trust or a foundation would work, it's transferred to the next owner immediately without lawyers and attorneys and anything else. Simply fill out a form and it's all done. The insured can be anybody with an insurable interest, which means I can be the owner and I could buy a policy on Phil if Phil's my business partner. If Victor works for me, I could buy a policy on Victor. I could buy it on my children, grandchildren, nieces, nephews, my mother, my father, my sister, my brother, anybody I have an insurable interest in. So it doesn't have to be just one policy on me like a lot of people think. Marcy and I already have 4, and we're working on our 5th one. One of our mentors has 107 policies. He was never insurable. He had cancer in his 50s, so he has 107 policies and not one of them are on him. Most people wouldn't even know that was possible. Beneficiaries work very much like a trust works. Contract. You tell it who is going to get the money. If you have 4 children, you can say, I want each one of them to get 25%. One of them gets in bad graces with you, you can fill out a form, sign it, send it in, no attorneys, no lawyers, no accountants, and just simply say 3 of them get 33% and that one gets 0. That's how easy it is. Or I want to leave half of it to my 2 kids and I want to leave the other half to my favorite charity, my church, my civic organization, whatever it is. You can pass that money on anywhere you want, and it happens at death. Present the death certificate, and the money transfers that quickly. No probates, no attorneys, no long waiting periods. In some cases, it's a matter of weeks. What was the lady that we just worked with recently? How long did it take her on that first policy? A couple weeks? 2 weeks, and they had paid her. 2 weeks. So if this is so powerful and wonderful, who's doing it? Well, guess who the biggest owner of these policies is? It happens to be U.S. banks. U.S. banks own more of these policies than anybody else in the world. And let me show you why. If you look here at these 4 banks right here, Bank of America, Wells Fargo, JP Chase, Citigroup, at the end of 2013, they owned $68.1 billion of these. Just the 4 top banks, $68.1 billion. But check this out right here in the second line. At the end it starts, just these 4 banks could potentially collect an upwards of $681 billion in tax-free income. You think they know a little bit about money? And you think they're doing some things that the rest of us didn't even know existed? 4 banks at the end of 2013, $681 billion in tax-free income falling to their bottom lines. How they did it? Remember what I said is I can be the owner of a policy and it can be on one of my employees. It needs to be on a key employee, typically the top 35%. But after teaching one of the classes, one of the gentlemen in the class was down in Texas and he ran into a banker. So the banker says they have a $25 million policy on me. And so I like to extrapolate that kind of stuff, and so I ran the numbers. So if he worked for them, if he made $250,000 a year and worked for them for 100 years and died, they would get a $25 million check, which means his entire employment would have cost them nothing. They'd have gotten 100 years of service from him, and it would have cost them nothing. Now, yes, they had to fund the policy, but they're getting the bulk of that money back, and you'll see why that wouldn't even have been that difficult to fund it. But the reality is that you're saying, well, yeah, but he's not going to work there 100 years. I know. That means they're profitable no matter what. But you know what's even better for them than him working there for 100 years and getting all the money back? Him working there for 1 year and quitting and going somewhere else and them replacing him and getting another $25 million policy? Because now in that same position, they now have $50 million guaranteed to come in. Because what do we know about you tomorrow? You're either going to wake up dead or alive. That's it. See, there is no risk here on the life insurance side. They know they're going to get their money, and they have a long-term view. Another thing we found out about the elite wealthy, they don't make decisions based on their impulse necessarily at that moment, and they use money thinking about the long-term future of that money, what it's going to do, where it's going to be, and how they're going to recapture it. They think long-term. This is why banks 681 billion, and I've updated that recently. As of December 31st of 2017, the banks now are up to $167.8 billion in BOLI, approximately increasing over 11.5%. When they went through the downturn of 2007, 8, 9, and 10, a lot of banks failed. Life insurance companies didn't fail, but banks failed. So after that debacle, banks in many cases upped their BOLI by over 50% because they knew that was money coming in and it protected their balance sheet and kept them safe. They're allowed by federal law. Actually, I went on the U.S. Treasury, and they actually teach banks how to do this. The U.S. government teaches banks how to do this, and it even tells them that they'd like to see them have their portfolio not have more than 25% of all their assets in this. Can you imagine when the federal government starts to say this is so important and so powerful that we're going to allow you to have up to 25% of your assets into this one idea? Well, why? Because it's guaranteed. Now, it does take time. People don't just sign up and die, but they're always going to get their money. And if we're doing it, so are we. So how does this work? Pulling some things together real quick here. We get a policy, which is the place that we're putting our capital in, and that policy, the capital grows, uninterrupted compounding, 4 to 6% for the rest of our life. We're able to borrow money, not from the policy, and this is a very important point for you to get. We're going to borrow the money from the life insurance company. This is how we prevent this from diminishing, because if I have a 401k and I go take money from it, it's no longer growing anymore. I can borrow money and pay it back, but at that point, if I had $100,000 and I take $50,000 out, I now only have $50,000 invested. And when I pay it back, it'll get reinvested. But with this, if I put $50,000 in here, the $50,000 is growing at 4 to 6% compounding for the rest of my life, even if I use the money. So we borrow money from the carrier and capitalize our private bank with it. Remember, I told you everything works the same here. I'm just looking for a powerful instrument that gives me a lot of benefits. The private bank then, no different than Wells Fargo did, then either we use the money from the private bank to eliminate debt or to acquire cash flowing appreciating assets. I didn't say to acquire flat screen TVs or depreciating vehicles at an excessive rate. Yeah, I'd love to see you buy your car through here, and you'll see that in a minute, but the idea is that we're going to take the money out of the private bank, we're going to use it to reduce debt or to increase assets. Either way, we're increasing our net worth. That's what we want to use the money for. There are other things we can do with it, but this is where we want it. And then we're going to pay back to our bank, just like we would of Wells Fargo, Citi, Visa, any of these places. We're going to pay ourselves back, or our bank back, with principal and with interest. And I know somebody right now is thinking, well, Tim, you're just playing a game. You're just moving money from one pocket to the other. And you're absolutely right. That's exactly what I'm doing. But your only other option is this. Move money from your pocket to theirs. It's your choice. You get to choose. Which one would you prefer doing? Do you want to be the bank? Because remember, we're not playing a game here. Think about it. If you take and put money in a bag and take the money out of the bag and over the next month pay the money back to the bag with interest, does the bag have money in it? Yeah. But if I take money out of my bag and I put it in Phil's bag, do I have any money in my bag anymore? No. Does Phil have more money? Yeah. Yeah. All we're doing is moving money from one pocket to the other in the same way you've always used money. It's just our pants that both pockets are in. Otherwise, this is our only alternative. This is it. Just like our little guys earlier. You made the money and you carried the money over and gave it to somebody else. And I know your mind right now, for some of you, is saying this can't be true. It's too easy, and if it was this easy, why isn't everybody doing it? Well, one reason, they don't know. Nobody ever came across this way. So what we're going to do is show you how the numbers would really work in real life doing this as a banker. So we're going to use a $25,000 deposit into we call it a premium deposit into our bank. We're going to put $25,000 into a policy and we're going to do that just for 5 years. And you can see that on your sheets. You got year 1 through 5, age 41 to 45. So the person that this was on, and this is a real illustration, a real analysis, was 41 years old and was a female, $25,000. And then they're going to buy a car in year 2. So I want you to see a couple things here. In the very first year, we put in $25,000, and remember I said we could have really high cash value? Within 30 days, we're going to have right around $14,563 that we can utilize. So what you have in front of you is actually a lot of numbers, but they tell a story, and I'm going to try and help you with that so you get a feel for what we're talking about here. So right here in the first year, we're doing $25,000 a year for 5 years, and then notice in year 6 it drops down to $10,000. We've found that the optimal way to fund these is to reduce in that 6th year because of the gains is most optimized. I didn't say that they couldn't be bigger. I said they're most optimized. And so we're trying to optimize this. We're not just trying to have money flowing in the wrong directions and not getting the best benefit out of it. So we put $25,000 in there, and in that first year, and immediately we have $14,563 of available cash on your sheet. In the second year, we now have enough cash in that policy. If you look over here, this is the total net cash value in the policy by year accumulating. So by year 2, we got $30,000 of cash in there because we've made a second $25,000 deposit here in year 2. But this year, we're going to buy a car. We're going to buy a $25,000 car, and we're going to pay cash for it. So we're going to be the bank. So we're going to take the money out of our bank. We're going to take $25,000 out of our bank, and we're going to then pay for the car, and we're going to make payments back to ourselves of $500 a month or $6,000 a year, and we're going to treat ourselves at least as good as we would treat our bank. We're going to make those same payments we would have made. Are we out anything on the loan side that we otherwise? If we'd borrowed the $25,000 from a bank and paid them $6,000, we'd have done that, principal and interest. We do it all the time, don't even think twice about it. So nothing different there. All we've done differently so far is we put $50,000 into this device, into this financial instrument. But look right over here, I want you to see what I call the program net result. That first year we put in $25,000, we can only get $14,500 of it out. So our net result of the entire program is we're down $10,000. In year 2, we're now down only $13,000 total, but we've got $50,000 into it. But if we'd been buying the car a normal way, the normal car loan result, we'd be down $6,000 at this point. So the net difference between these two, so I'm trying to help you understand what these charts all mean. So the PBC is private banking concepts versus conventional. The first year we're down $10,000, that's the same across the board. The second year we're down $7,000. The third year we're actually ahead of the game in year 3 using the private banking concepts. But remember, despite the fact I borrowed this money and I'm using it for my car, the $50,000 I have in there now is growing, compounding endlessly until I die at 4 to 6%. Uninterrupted, continuous compounding. Even though I've used it to buy a car and now I'm paying myself back. So let's look at some key points and see what happens with it. Year 4, I put in another $25,000, and I just want you to see what's going on here. I now have, if I'd have been buying my car conventionally, I'd be $25,000 out, but now I'm ahead $31,592 compared to that. And look what else is happening. See, we only structure these policies in such a way that the death benefit will continue to grow. Most of you have been buying a fixed amount of death benefit for a certain amount of money, and that certain amount of money can go up. With ours, what you're paying for the policy goes down and the death benefit goes up. We've reversed the paradigm. We've completely changed how this is working. So by year 4, just in 4 years alone, our death benefit went from $951 to $1.1 million, almost $1.2 million. Just it's grown that much. So what is that, $300,000 growth roughly? So let's check in again a little later on. Now we're going to do the same thing. Is what we decided is this person wants a new car, a new $25,000 car every year for 5 years. Every year they want to get a new one, and they're going to finance it for 5 years, but they're going to finance it from themselves. So let's go down here to the 15th year, our third car. Right here, our third car, and that's actually in the, what is that, the 12th year? Yeah. 12th year, third car, $25,000, and we make our payments to ourselves just like we always have. If we'd have done this conventionally, we'd be out of pocket about $72,000, and instead we're ahead $186,000. The only difference is we're the bank. All that money and all the interest is coming to us, and that money has been growing the whole time. By that 12th year, we've put a lot of money in there, and it's just growing like crazy now. And our death benefit goes up. So let's look at a few things about, retirement numbers. There's a lot of people say, I'd love to retire at 55. I hear that number a lot, quite honestly. That would be their dream. At 55, I put in $10,000. I'm still making my car payments to myself. And the cash value growth that year alone is $22,459. So I put in $10,000 and I get $22,500 back. That's 120% return on my money in 30 days. Pretty good ROI. And at 55, I still have now my death benefit's up to $1.7 million. And let's look at the difference between the two programs. If I had been, there we go. If I had been doing this conventionally, I'd be out of pocket 84 grand on my cars, and that money would have flowed through my hands and left my family forever. But by doing it this way, I've now increased my net worth by $233,916. I could have been out of pocket $84,000, or I could have increased it $23,000 or $233,000. Your choice. Age 65. So this person, if the 55-year-old actually has $1,000 a month of income coming in that's tax-free at 55 years old. Would that help somebody retire an extra grand a month? Yeah. How about 65? Same thing. We're still buying cars, $10,000, 6,000 payments. Our growth this year is $36,318. I put $10,000 in, and I get that $10,000 back plus another $26,000. That's now $2,000 a month of additional income tax-free into my life, only because I changed where I'm banking, and I put it in, as a friend of ours says, into a stupid-ass life insurance policy. I mean, it really is a simple tool, one that most people just don't understand the power of or how to structure it. My difference now is, at this age, my cars would have cost me $144,000, and instead, I'm up $548,000 to the good of my overall wealth creation by the time I'm 65. Well, it keeps going. And actually, it goes until you're 121 years old. At that time, it maxes out, because they figure that's now, they just changed it from 100 to 121. They're finding that people are living longer. Well, that's good news. The bad news is their money is not living longer. If the normal expectancy was in the 80s, and now they're saying that it's going to be pushing up to near 100, that means your money has to last another 20 years longer. In reality, what they're already starting to say is most people need to give up on the thought of a 65 age retirement and start pushing that towards 72 just to start today, unless something happens with their money in the meantime. Better plan on 72. So let's look what happens for this individual. If you look up at age 72, what's becoming the new retirement age, and you look at that top line there, we got $10,000 again. We're still buying cars from ourselves. We're going to buy our last new car this year, pay ourselves $6,000. Our cash value increase that year is $49,260. That's almost $1,000 a week. Take the $10,000 out, and it's still $40,000 of tax-free income that year. There's a lot of people in this country who don't make $40,000, and they have to have taxes taken out of that. And if you've been doing the banking properly, you shouldn't have a whole bunch of debt by now. because you should have been paying that off, and we'll show you that in a minute. But that $40,000 goes a long way in retirement, especially on top of things like Social Security. Also, a little known fact about Social Security. They'll tell you that Social Security is not taxable. That's true if that's all you're receiving. If you have a 401k or a traditional Roth or anything that was tax deferred, the money comes out, and not only is it taxed to you, but it can change your tax bracket to the point that now your Social Security is taxed. So if you make too much money in your retirement years, your Social Security can also be taxed. So this money comes out in a way that doesn't create a taxable event, therefore your Social Security isn't going to be attached. You can say, well, you know, if I have enough money when I get to be, 70 years old, I just won't take the money out of the 401k. Can't do that either. They know what they're doing. They mandatorily make you take a distribution. They call it a recommended or a required mandatory distribution, so that you are driven to start paying taxes on that money. They will not allow you to transfer that money to the next generation without paying those taxes. And if you don't take it, they will fine you, so they're still getting their money one way or the other. Yep, correct. So again, if you look at 77, this is the last, we paid off our car at age 76, and we decide we don't need any more cars, and somebody says, oh, then this thing's going to start to fall apart now because we're not borrowing from ourselves. No, we now, all of this money for the last 37 years we put in there has been growing and compounding at 4 to 6% interest, and will continue to do so till we die. Look what happens. I'm not making car payments anymore. $6,000's gone. I now have available cash of, if I haven't used it for anything else, of $1.1 million. I'm now getting, my cash value growth is $54,575 a year, or $1,000 a week of income, tax-free. Anybody make you a good retirement? $1,000 a week, tax-free income? Look what's happened as well on what our program has done overall. Our death benefit is now almost $1.9 million. And our difference by using the private banking concepts over buying our cars any other way, by this time we would have spent $210,000 on cars, and instead we're up $1.14 million. All we've done is buy our cars from ourselves and put our money into a life insurance policy that is properly structured. You get the idea. And it just keeps on going on. For a woman, this was a 41-year-old lady. The typical age currently, and they're actually expanding this now, for death is 87. And so let's look at what's happening at that point in her life. She puts in $10,000. She gets back $87,565 in 30 days. That is a 700% profit in 30 days on that transaction. Now, yes, it took all of those years to get it going, but it's either going for you right now or against you, and it's all going into somebody else's pocket. And her death benefit to her family, tax-free, $2.44 million. Tax-free transfer. So anybody seeing a pattern here of all the things we talked about had to happen, and we're doing it all with the same dollars? So in order to maximize this, all we've talked about is buying a car. We've isolated just buying cars until this individual was in her 70s. She bought her last car at 72. But what would this look like if we actually took more of people's debts?